Let's get right into it. What if I told you that for the first year you're paying your mortgage, a massive 85% of every single payment you make is pure profit for the bank? Yeah, you're building almost no wealth at all. It's a pretty shocking reality, right? And it totally challenges what we've been told is the biggest and best financial decision of our lives. We've all been taught that a house is the ultimate asset. But today, we're going to strip away all the emotion and just look at the cold, hard numbers to figure out if it's really making you wealthy. All right, let's dive in.
Wow. Okay, that sounds almost sacrilegious, I know. But listen, this isn't about the American dream or having a white picket fence. This is strictly about the math. We're going to answer what is probably the single most expensive question in all of personal finance. Is your home the foundation of your wealth, or is it just a very, very expensive place to sleep?
So, here's the paradox, the central problem. The most valuable thing you own is also this thing that just relentlessly demands to be fed. I mean, every single month, money just bleeds out of your account for the mortgage, right? Then there are the property taxes, the insurance, and oh yeah, the surprise leaky roof that's going to cost you thousands. It is constantly taking money out of your pocket. This is that classic trap of being house rich and cash poor. You know the feeling. Your net worth statement might say you're a millionaire because your house has all this equity, but let's be real. You can't buy groceries with your front porch. All that wealth is literally trapped in the drywall. It's illiquid. It's inaccessible until the day you decide to sell the whole thing.
You know, the reason this whole debate even exists is because we're all working from two completely different dictionaries when we use the word asset. The entire conflict, seriously, boils down to this one simple disagreement.
So let's look at them side by side. For a bank, your house is absolutely an asset. Why? Because it has liquidation value. If you stop paying, they can just sell it and get their money back. Simple. But for a cash flow investor, an asset must put money in your pocket. It has to generate income. And by that definition, your home is a massive liability, constantly demanding to be paid. Okay, to settle this once and for all, let's actually run the numbers. We're going to pit a disciplined homeowner against an equally disciplined renter who's going to invest the difference. We'll call it the 30-year financial race. Let's see who actually comes out ahead.
So here are the rules of the game. The house costs $400,000. Our homeowner puts down a solid $80,000. Our total monthly cost to own, we're talking mortgage, taxes, maintenance, the whole shebang, is about $1,928. Now, our investor renter, they find a similar place for just $1,600 a month. They take that $80,000 they would have used for a down payment and invest it. And, this is the critical part, they also invest the $328 they save every single month.
Now, before we can crown a winner, we have to talk about a little secret. It's a secret that banks absolutely love, and most homeowners, well, they're completely in the dark about it. It's called the amortization curve, and trust me, it dramatically changes the outcome of this race.
And here it is. This is the trap in a picture. In the very first year of a 30-year mortgage, a shocking 85% of your payment is pure interest. That's just profit for the bank. You are barely making a dent in the actual loan. You're building almost no equity whatsoever. It's wild.
So here's the key takeaway from that. It takes about 15 years, that's half the life of the loan, before the majority of your monthly payment finally starts going toward your equity instead of the bank's pocket. Now think about it. Most people move every 5 to 7 years, so they are constantly resetting this clock, basically paying almost pure interest forever.
Okay, let's fast forward 30 years. Our homeowner, they did it. They paid off their mortgage. Assuming a pretty modest 3.5% appreciation, their $400,000 house is now worth about $1.1 million. I mean, that sounds fantastic, right? A paid-off house and a 7-figure net worth. They won. Or did they? But then, look at this. Thanks to the magic of compounding, our investor renter, who just put their money into a simple stock index fund, also has a net worth of roughly $1.1 million. So what's the difference? Well, the renter's wealth is completely liquid. They can sell off a portion anytime they want. The homeowner? They can't sell their bathroom to pay for a medical emergency. Okay, so based on those numbers, it really seems like renting and investing is the clear winner, right? But hold on, because the math doesn't tell the whole story. Homeownership has a super powerful, hidden financial advantage that we have not even talked about yet. It's a concept economists call imputed rent, and the easiest way to think about it is this. It's the rent you pay to yourself. See, when you own your home, you're your own landlord. The value of that shelter you're getting is like a dividend. And here's the best part. Unlike a stock dividend, this benefit is completely tax-free.
And this advantage just gets bigger and bigger over time. A fixed-rate mortgage is one of the best shields against inflation available to an average person, period. While a renter's biggest expense, their rent, goes up and up and up year after year, the homeowner's main payment is locked in stone for 30 years. Over time, that fixed payment starts to feel incredibly cheap compared to the rising cost of renting, which frees up a ton of cash flow later in life.
So, as you can see, there is no simple answer here. The right choice really depends on your local market, your timeline, and honestly, your personal discipline. To help you figure it out, here's a simple mathematical toolkit to take the emotion out of the decision.
All right, 3 quick rules. First, the 5% rule. Just multiply the home's price by 5%, then divide by 12. If you can rent a similar place for less than that number, renting is probably a better deal, mathematically speaking. Second, the 10-year rule. Closing costs are brutal. You really should plan to stay put for at least a decade just to break even. And third, the affordability cap. Keep all your housing costs, all of them, under 30% of your gross income so you actually have money left over to, live and invest.
Ultimately, the real answer to this question, it comes down to you. If you buy a modest home, you stay put, and you use the stability of that fixed housing cost to aggressively invest your other money, your home can be an absolutely fantastic foundation for wealth. But if you buy a home you can't really afford, and you're just counting on its equity as your only retirement plan, then it becomes a parasite, just draining your financial future. The goal isn't just to own a home. The goal is to build wealth. And the secret is to own your home, but never ever let your home own you.